Hey there, traders. Todd here. Welcome to the whatever this is, super late Thursday night live stream. Just cranking through here Thursday, just getting as much done as we can ahead of the weekend. It's been an unbelievable week. A few thoughts I wanted to share with you. Headline, yep. We'll talk about it. A Dow with a six-figure price level. We'll talk about that. We'll talk about interest rates and yields. I haven't done a YouTube video all week. Apologize. And that was kind of the theme that I was sharing with you guys last week, and what we've been doing, at my research and wealth management business, really focusing on yields. This driving this rotation. I'll show you what's going on with that. What else is on the list? Growth value. We'll look at the NASDAQ, six-figure Dow. Let's compare first. Let's start against a analog. And, people have sort of mixed opinions on this. Looking at some period in the past, comparing it to today, overlaying it, you'd call it an analog, and see if there's any any help that the history can provide today. And there's one little comparison that I want to share with you that I think is somewhat interesting. I think it's nothing like, oh my God, this is definitely going to be our path, but I think it's noteworthy. So what we're doing here is, this is the NASDAQ going back to September and October of 2000. Okay, so the best analog or overlay I can find is from this point here down, and just as I've labeled for you right here, you are here pretty much. So this is December 2001, and if today's stock market sell-off could potentially be overlaid on this NASDAQ sell-off back from 2000, 2001, here's what it looks like. So the red line here is the NASDAQ, again, since September of 2000, and that's this red box right here. The teal is the NASDAQ since November 9th of 2021, which will bring you to today, which is right here. You can see, I can't move my cursor, but if you look at that lower gray boxes as daily historical comparison date 3/22 of 23, which obviously is yesterday and today. So this is the current NASDAQ. And if you look at this, again, this is not the high from the NASDAQ, but it's the secondary high from the great tech bubble. And if you kind of follow the cursor down, I think you'll see there's a lot of similarities here. So this was the rally back in actually March of last year, failed. And then back here, this was January of 2001, sold off, made a low, rallied back up. The high here back in 2001 was in May. This high up here was in August of 22, sold off. And now all of a sudden, you're getting a little bit of this is that double bottom that we've seen in the NASDAQ here. And what's happened here is both the NASDAQ ever since 21, or sorry, this is going to be, 22. This is December and January of 22. Here we are now rallying. Now we're in 23. This is the NASDAQ. And the analog overlay comparison back in 2001, I would think puts you right about here. Okay, so if you overlay again, this is going to be the rally. This part of 23 right here in teal. This is this year right here. We've sold off, come back, and we're trying to break through again. I would say the comparison is right about here, again, back to 2002. Now, in 2002, we obviously failed. Okay, so 2002 in January was right about here, and you can see the NASDAQ sold off through the rest of the year. And as I scroll forward, you can see what happens. The NASDAQ has an ability right now to divorce itself from this analog overlay, and if it wants to continue higher, I'd say you can delete this overlay, this analog, and say history is not a guide for what we're doing here going forward. Okay, that's that. Now, why are we seeing perhaps a break from the NASDAQ, the overlay today compared to 21, 22 years ago? I think a big part of it has to do, as I mentioned in the beginning, with interest rates and yields. So what do we have here? We had a very significant yield curve inversion, and that's what everyone's been talking about all last year. And that exists when short rates are higher than long rates on the U.S. yield curve. Generally, a normally sloped yield curve, your 3-month, 2-year, 5-year should be lower than your 7, 10, 30 years. Anytime that doesn't happen, when you have shorter rates that are higher than longer rates, that usually signifies, they say, a coming recession. Well, here's the inversion that we've seen that really began here in July of 22. We became more and more inverted. We reached a max inversion about 1.07%. This is the 2-year Treasury and the 10-year Treasury. Well, what's happened after the big move down in rates on the long end of the curve, that inversion has been cut in half. So we went from a full 100 basis points of inversion, now only have 0.48. So, we're only at 50 basis points of inversion, and there's more signs that the curve is gonna stop being so inverted and be shaped in a more normal fashion, which is this way. I guess it would be called disinverting, uninverting, perhaps, however you want to call it. So I kind of want to look back and say, what happens when the yield curve uninverts or becomes more normally shaped? There's a lot going on in this chart. I'll try to break it down as simply as I can for you here. So we're looking at a few things. First thing we're looking at here is that 10-2 spread. Okay, that 10-2 spread. Let me get rid of that. Can I get rid of this? No, probably not. That's okay. So the first thing we're looking at is the 10-2 spread in red right here. Anytime you get below this 0, that's going to be what you call yield curve inversion. And generally, anytime you see yield curve inversion, a gray area comes up, which is a U.S. recession. Okay, so we had inversion back here, and I'm looking at dates right here. In 89, we went into recession. In 90, that was right around the first Gulf War. Of course, this was 2000, tech bubble, recession, global financial crisis, inversion. So what happens is usually inversion, since 89, inversion usually foretells recession. Okay, it happened going into the first Gulf War, happened in the tech bubble, then we had recession, happened global financial crisis, inversion, and then we had recession. Well, we came close to inversion, then we had a very short recession with the pandemic. So, all right, let's set the recession stuff aside. Let's focus now on the orange, which is the S&P 500. And then up here is the federal funds rate, where the Fed is setting the rate, and the blue is 10-year Treasury. So what I'm doing is I'm looking at the Fed funds rate and 10-year, okay? But I'm looking at the 10-2 spread. I could look at the 3-month, 10-year spread, but it's fine. It really serves the same purpose. The point that I'm making here is it's easy to look at this chart and say, okay, we get inversion, recession happens, orange, which is the S&P 500, sells off. We get inversion right here with the red. We go into recession, and in orange, the S&P 500 sells off. Back here, we got recession. We got inversion right here. This is going to be back in 89, heading into the first Gulf War. And then we got recession some period later. What's different this time? Okay, what causes the inversion? All right, going into the Gulf War, let's look at Fed funds, okay, and the 10-year. Why was there inversion? Well, if you look at these two numbers here, let's look at 10-year and the Fed funds rate. 10-year was at 9.02, overnight Fed funds was 9.8. Rates were too high. What happened going into the Gulf War? Green, which is your Fed funds, it just got smoked. right? The Fed was cutting rates to stimulate the economy because we were looking at a recession in 89 and 90. The Fed was cutting rates. That caused the yield curve to become more normally shaped, get back above zero. Little stock market sell off, but then the stock market went significantly higher. We had yield curve inversion here heading into the tech bubble. Stocks were way too hot with the tech bubble. You had overnight Fed funds at 6.86, 10-year yield at 6.03. Okay, inversion. Then we had Fed funds getting slashed, Greenspan slashing rates in response to the tech bubble. That caused the inversion of the yield curve to unwind with the stock market selling off. Same thing, heading into the housing crisis that Greenspan also precipitated by slashing rates too quick. We had yield curve inversion going into that. What caused it to unfold? Well, we slashed rates, right, in response to the housing crisis. So what happened is the S&P in orange sold off sharply. So a couple people I've heard them say, well, anytime the yield curve disinverts, I don't know if that's the right way to say it, but is no longer inverted and is more normally shaped, the stock market sells off. Yeah, that happened in 2000 and 2008, but it was the Fed that had to cut rates from some kind of event, being tech bubble, the housing bubble. The Fed had to slash rates in response to this new crisis that was happening. That caused the yield curve to become normally shaped. Well, the Fed was cutting rates because the stock market was falling. This is not happening right now. We have long-term quantitative easing that we're dealing with. We have inflation post-pandemic. We can't cut rates right now. We can't. Or the problems that we're trying to unwind over the last 15 years of quantitative easing and the fiscal response to the pandemic, that's going to cause even more inflation. So you're not going to get the Fed cutting rates to catch up to an economy that's falling because of for some reason. That's not the situation right now. So you can't say, well, when the yield curve disinverts, stocks fall off. No, because we had two other outside forces working on the market right now, tech and housing, right? So you can't cut rates right now. So, okay, we have yield curve inversion right now, all right? It's becoming less so, but I almost wonder, is it going to be something like back here in the 80s, where we had to deal with yield curve inversion, coming out of the late 70s all the way through 81, 82. And if you look at what the stock market did, yeah, we had a little sell-off, but that was the birth of the tech bubble, or the tech boom, not the bubble, the tech boom in IBM in 1982. That's what started one of probably the greatest bull market this economy has ever seen, right? So we might have yield curve inversion with us for some period of time. Stocks could rally on that. Fed's not going to be cutting rates unless some big significant catalyst happens and the Fed has to respond, and that usually would accompany a falling stock market. I think we're a long ways from that, okay? So I'm not all that concerned because it's not 2000 and it's not 2008. I hope that makes sense. All right, let's take a look at yields. Let's take a look at the 10-year and show you where we are now. So this was a key level on the 10-year yield, up around 4.07. This was a resistance zone that we flagged. We pegged with our customers ahead of time. We held it perfectly. It was an X-wave flat. We've backed off. Now the 10-year yield's holding 3.37. So what's going to happen here if the 10-year yield drops further? If the Fed, the short-term rates don't go down, that's going to keep the yield curve more and more inverted, okay? So we have to watch how the stock market behaves if we break through this 3.37 move in rates, okay? Now, what's also interesting is the short-term, the 2-year rate dropped pretty sharply today, okay? So let me just pull this over. We had the short-term 2-year Treasury rate drop 5%, and we're down to about, where are we right now? 3.76. It's a pretty big drop. And if you look at this guy, it's not going to be the best chart because I only get end of day quotes on the 2-year here. But if you look at the closing price, look at the big drop we've seen in the 2-year yield, which does have a big impact on Fed funds. 2-year yield was all the way up about 5.05. Today we closed down at 3.76. So again, these are closing prices each day. So it's not the prettiest chart, but that's okay. You see the picture here with the line chart. So 2-year yields just got hammered on the downside. So we have interest rates collapsing right now. What's that going to do to the stock market? Well, we have seen a pretty good rotation into growth. All right, we've seen a pretty good rotation into growth. So let's take a look at that. Here we go. Okay, I want to take a look at this. This is going to be your growth value ratio in white, right here, overlaid on your 10-year yield. Okay, we're really focused on interest rates. So this is the ratio between IVW, IVE, growth value. Growth value, okay, in white, I kind of have those mixed up. It should be up by the other one, that's okay. So you see where we're going here. What's happened is as yields, 10-year yields in orange have moved up, what's happened is it's hit the growth trade because higher interest rates make investors question if they want to hold such high valuation growth stocks that benefited so much during the pandemic. As yields start to move up, the formula for valuing stocks becomes more and more challenging to justify higher valuations. So the growth value ratio sells off. This means growth stocks underperforming, value stocks outperforming, and that's been the case since the end of 2021 all the way down to the end of 2022, 1 year of it. And what's happened now? Well, as I just mentioned, that 10-year yield holding over here about 3.37%. What happens if the 10-year yield breaks down? What happens if the Fed is done raising rates? What happens if we're at terminal Fed funds right now, spurred by this banking crisis? Will the growth trade continue to rotate back in? This is a pretty steep little move here. This is the NASDAQ down here, okay? Tech stocks have gotten wrecked. We know that. But what does this pattern kind of look like to you? Sort of looks like maybe a left shoulder, sort of a double head, a right shoulder. We might be carving an inverse head and shoulders here. And if this dynamic of rates, rotation into growth happens, I don't see why the NASDAQ wouldn't continue higher. And if you take a look at semis, look at NVIDIA, holy bananas. We're like 275, the all-time high is like 325. I mean, it's not far from an all-time high in a huge semiconductor like NVIDIA. A lot of strength in semis. Okay, so I wanted to show you that one. Let's take a look at the NASDAQ. We'll go right to the NDX 100, which is going to be right there. Pull this guy over for you. So what's going on in the NASDAQ? Well, it's interesting. Guys, put very simply, anytime you see generally 3-wave moves, kind of shaped like that, usually it suggests that that is a counter trend move. I would suggest, and it's not perfect, I would suggest that this is potentially a big 3-wave move from the high in late 21 down to the low here in October 22. This is potentially a 3-wave move. This little guy here does challenge that a little bit, and there's nothing perfect. There's no, the market's not going to raise a big red flag at the bottom or a green flag to say buy. It's possible that that's a 3-wave move. On the flip side, what do we have in the NASDAQ? Well, the NASDAQ, right during the Fed, went up and broke the February 2nd high, which is right here. By breaking that February 2nd high, and we did get a pretty sharp reversal yesterday, but it came back and reversed again today, all of a sudden we have, in the Elliott wave world, a 5-wave potential diagonal off the lows, which, okay, if we had a 3-wave move on the downside, we have a budding 5-wave move on the upside here and in the NDX, perhaps the trend is now up. So let's take a look. We have 12,902 in the NDX. I mean, take a look at XLK. This is a pure technology guy right here. I think it's harder to argue against what I'm saying, that I believe that's a 3-wave move and the technology ETF, and this is forming a 5-wave move off the lows. If you get up and break through 152 in XLK, that's going to suggest we might have seen the lows. Take a look at the SMH, ripping on the upside. Broke through resistance. Don't see any reason we can't be getting up to 280, 290. You're talking an all-time high of 318 in the SMH. Guys, you're talking about a tech wreck. Everyone thinks we're in a bear market. Dude, look how far off, look how close we are to the highs. We're 18% from the all-time highs in the semis. And keep in mind, these guys are up thousands of percent from the credit crisis lows. Thousands of percentages, okay? 18% is nothing, all right? So that's the NASDAQ, that's SMH. And finally, the reason probably a lot of you are still watching this is a crazy headline that I put out, which is Dow with 6 figures. Could you see it? Well, let's take a look. All right, I know there's a lot of stuff on here, but put simply, this goes back all the way post 1929 crash. All right, I want to focus on the teal wave counts here, and there's a lot of stuff on here. There's a lot of calculations. I've been following this very closely. What I would suggest to you is if you follow the Elliott wave theory or you've studied your technical analysis, you know, Charles Dow, he was the grandfather of technical analysis. He gave us that there are 3 main trend waves in any good move, any good market cycle. Number 1 is called accumulation, okay? Post-29 crash, heading into the 60s and 70s. Then you have a correction. And the fact that the 60s and 70s was just sideways is indicative of a lot of coming strength in the next phase, which is called widespread participation. Okay, that was the 1982 rallies I mentioned up to 2000. That was the best bull market we've seen in this country yet. All right, that is typical of a third wave. Then we have tech crash, housing bubble, global financial crisis, 3 waves in wave 4. Now, I would propose to you that we are in the 5th wave, which is called distribution. The good news is, after wave 5, we have a correction, and I'm going to get a little Elliott wave on you here, those of you who've studied. It is a correction that would mirror the sell-off right here from 1929 down to 1931. Okay, so I would say that following this move, we've got a sideways period of consolidation. We're talking 10, 15 years out. Now, how far did trend waves 1 and 3 last? Well, wave 1 lasted 980%. Okay, so from 1942, World War II, into 1965, Beatles come to America, 980% rally. We then went into a decline. Now we get the 82 to 2000 bull market, which was 1,426%. Then we do tech crash, housing crisis, GFC. The net decline was 44%. How far have we gone so far? So we have a 980% rally. We have a 1,400% rally. How far have we gone in the Dow from the global financial crisis lows, we have gone, it'll pop up here, 385%. That's it. 980, 1400, 385. Trend waves are related in both price and time. So far, this is too short to call it all of wave 5. And I have exact calculations here if you want to take a screenshot or get in there and pause the video. So if you take wave 5, 61%, which is golden ratio, of your 980% rally is a 605% rally. Minimum target is 39,000 Dow. 61% of distance traveled in wave 3, which is again 1,400%, that's 881. That gives you this 56,000. And then 100% of wave 1, which is 980, and ongoing wave 5 is Dow 63,000. These are your immediate targets. But as I scroll in here a little bit, the way you have to count this, if you're being genuine with Elliott Wave, is I think that the pandemic was a expanded flattened wave 2. This is by far the largest correction we've seen post GFC. You can't tell me that this little correction here or this correction here is similar in price and time to this guy. This is the highest degree correction we've seen post GFC. Therefore, it must be wave 2, which means we have wave 3 to go. Okay, so this is your path to Dow 100,000. And we're talking down here, if you look at, the price scale, it could be, you could be out in 2035, 2040 by the time it happens. But you're talking Dow 100,000 up around here, I would say. Okay, and does it look obnoxious compared to what we've seen the stock market do? Nope, it looks like normal business. Keep in mind, we have inflation now. We have inflation we haven't seen. So the stock market is going to be going up as inflation continues to go. Dollars become cheaper, money's out there, chasing stock prices higher. Monetary supply, M2, continues to be strong. The Fed balance sheet just exploded back up after supposed to be doing quantitative tightening. So it doesn't look all that obnoxious to me. So when people say this is the end, I don't buy it. I don't see it. I will be prepared if we do have one more leg down in a wave 2, but I do think we are going to embark on a pretty significant rally from here. So hopefully that helps. Is anybody here watching? A few people. Let me know what you guys think. Also, there's one other thing. We did a webinar last night. The archive is up. It's all about the software I'm using here, Motive Wave. And also, I did a webinar talking about Elliott Wave, about what it means to us, how we use it, how we set up trades, so on and so forth. So what you guys can do is go to this website if you want to see the archive. Go to Trading Analysis. Let me show you my screen. Go to tradinganalysis.com/madness. If you do that, that will drop you right on the webinar replay right here. I thought it was a pretty good webinar. I put a lot of work into it. Went more in detail about the Elliott Wave theory, about Motive Wave software, which is on sale right now if something you want to get. But there's, I think, a lot of good content in there. So again, tradinganalysis.com/madness. Okay? Guys, thanks again. Appreciate you hanging out with us, and we'll see you on the next video update. Throw a question, comment in there if you don't mind. I'll be sure to respond to all of them, and we'll see you on the next stream. See you guys.